Welcome to the Salty Investors, episode number 50, half century. It is Friday, 29th of September, 2023. How are you on our 50th anniversary, Tim?
Oh, very good. Yeah. It's my birthday today, so I'm 45. So
Oh, it's your birthday too. Oh, my
yeah,
God.
big
Double
numbers
whammy.
today. How are you going?
Yeah, I'm all right. It's warming up down here. Things looking good. The uranium price is now $70 a pound. It's all good news.
Yeah.
But let's, as it is customary, let's get to the salt. What have you got for us this week, Tim? You want to lead off?
Have you heard of? I'm pretty sure you've heard of buy now, pay later, but now they've got eat
Oh, yeah.
now, pay later. They're like afterpay for the supermarket. You know, a large number of customers are now asking for it. The cost of living is getting out of control, but clearly this is a sign of serious distress in the community. With higher interest rates for longer, this might not be short-lived. Have you heard of this before? Eat now, pay later?
No, I haven't. How does that work? So you get to go in the supermarket, grab a bunch of stuff and eat it, and then you pay for it later.
Yeah, over 4 easily installments, you know, with interest-free, remember? But if you forget to pay it, you don't pay it, you're up for money on your food.
Yeah. But isn't that what a credit card is? Buy stuff on a credit card and you've got, 45 days to pay it or something? I mean, isn't that what is... How is this any different?
But millennials like this more, obviously, and so. But, like, it's how serious it is that you got to put food on your freaking, on credit. Like, normally you should be going, well, maybe we should be cutting back something so we're not using credit to buy food. Like, you're pretty much getting in a bad situation if you're starting to put food on the credit card. Like, unless you're ultra wealthy, it makes no difference. But if you're in the, working class or poor, like, boy, that's serious. Like, it's going to be a spiral. But I remember being poor when at university, forgot which week to pay rent, and for a week I was eating rice and soya sauce. I don't know. So, we've all got to, you have to make some sacrifices, don't you? You don't go put it on the credit card, surely.
Well, that's the thing. You got to cut. What other choice do you have? I mean, because I just don't. I don't get it. I mean, look, Afterpay. If Afterpay hadn't timed their exit so well, I mean, it never made any money. It was a bad idea. It didn't. I mean, whoever bought it is now writing down the value of it on their balance sheet because they paid too much for it. I mean, it's what it means is you don't have the money for the things, so you don't get the things. That's usually, I don't know.
Yeah. Well, I don't know. Seems to work people for the last 30 years because, lower interest rates have just kept on bailing them out. And you'd be able to get away with it, and in the future, money's cheaper because interest rates are lower. Yeah. But that may not happen for the next decade. We may have, holy hell, 5% interest rates. Who knows? 3%. I don't know. So, yeah.
Well, see, I like the old lay-by system. Do you remember the old lay-by system when you went into Kmart and there was a counter up the back of the store, and my brother and I wanted to buy a video game, and the video game was say $30, and we go in there every week and we put down $5.
Okay.
And then the week after you go, and now you've paid off 10, and now you've paid off 15. And you know what? You know what the difference was? You didn't get
it.
The product until you paid for it. That was the difference. Mm-hmm. Your cat seems to remember.
Yeah, he's having a bit of a complaint about it, but yeah. That's not too bad a system. You're incentivized to save, and you've got the product there, and you've got something to work towards, and you can't go into a huge amount of credit debt. It's not a 20% interest rate on this thing. Like, there's no,
and you get the product after you've paid for it. That teaches you some sort of responsibility that I need to have the money for the thing before I get the thing. Yeah. I don't know. I'm just too old-fashioned, I suppose.
Yeah. What are you salty about this week?
Oh, well, I don't know if you saw last week, Chris Minns, the Premier of New South Wales, came out in support of the federal government's decision to lift immigration in New South Wales, as if New South Wales hasn't had enough immigration over the last 12 months. Because according to Minns, a lot of that labor, this is a quote, a lot of that labour coming into the state will be directed to the housing market, and we need them to build houses and apartments. But he didn't complete the thought, which was we need more immigration to build more houses and apartments for the increased immigration. Have you ever heard of a vicious cycle? Now, this week, the opposition leader, Mark Speakman, said that Australia needs, quote, significant population growth. Otherwise, we risk not being able to securely maintain occupation of the Australian continent. So we need more people to defend the continent. Well, good luck with that, given the size of our coastline. So congratulations, New South Wales. You now have bipartisan support for the continuation of the immigration population Ponzi scheme.
Yeah, when you've got both sides pushing it.
Yeah.
Where's the reprieve there, from an alternative opinion put up? Well, yeah, I just don't see how it's going to help.
well, Leith Van Onselen also put up, he was talking about this, and he put up a poll from 2019, December of 2019, so this was before COVID, that 80% of New South Wales residents did not want an increase in the population of New South Wales. All right. So again, this is what's so interesting. And if you've ever read Douglas Murray's Strange Death of Europe, that governments have consistently had immigration programs that the vast majority of the population generally disagreed with, but they've done it anyway, and they continue to do it. And it just sort of happens out of view, right? People can say they're against it, but it happens anyway. They just do it.
Well, number goes up, How do you lift GDP? With productivity going down the crapper. Like, oh yeah, you can still lift GDP by increasing the number of people. Like,
I do see more people referring to GDP per capita, because more and more average people have figured out that, I mean, just you don't even have to do the numbers. You can just look at, okay, so what they want to do is build more egg crate apartment blocks. You saw the thing that Anastasia Palaszczuk came out with the other week, which is basically a slightly bigger than a caravan size small house that they're going to build. I mean, you're talking about declining standards of living. People can't afford real houses in suburbs and neighborhoods, so we're just going to cram you in. It is a country in decline.
Yep.
And on top of that, you've got the ridiculous net zero bullshit, which is just going to make everything more expensive as well. But it's all right if you're, if you're earning a few $100,000 a year, you'll be all right. Everyone else, fuck them.
Fine. Yeah. Oh, well.
All right, let's get on to the very boring but sometimes interesting macro stuff. So this is just fantastic. So retail sales was up. I mean, it was just seasonally adjusted, 0.2 for the month, 1.5 for the year. But remember, inflation's about 4 to 5, and the aforementioned immigration Ponzi, because we had a population increase last year of over 500,000 people once you add in births and immigration. So you've got retail sales going backwards at about 5% inflation adjusted. I mean, that's what it amounts to. Retail sales going backwards at about 5%. Yeah.
Yes.
Because I mean, look at that. That's the dollar level again, not inflation adjusted. And it's just flatlined. And it rarely does that, right? Like it's I mean, it's quite amazing. So I mean, there's a lot more pain out there to come. And
2019 wasn't that long ago. Like, look at that, and
so. This is just another one. Job vacancies came out. It's sort of falling off a cliff. I mean, look, that's still a healthy number of job vacancies, right? That's not bad, but it is coming off pretty decisively, and that'll probably only get worse. It's down about 15% overall. Of course, the public sector is only down 3% over the year, and the private sector's down 17%.
Oh no, what's going on there?
Which is, that's hard to figure out, isn't it? Maybe it's a little bit harder to lose your job in the public sector. I wonder why. Okay, we had inflation come out, and guess what, Tim? It's not going down in a straight line. It isn't, is it? It's not just falling off a cliff back to the
Oh.
magic 2 to 3% band. We're
Mm-hmm.
kicked back up to 5.2%. But of course, if you want to look at the X volatile items,
Mm.
it's still sort of coming down. The two are about to meet. But I saw a few people saying actually interest rates have got to go up again. I think
Yes,
a
seen it.
month or so ago it was all over. There's no
Yep.
more interest rate rises. And I saw someone yesterday saying that, was it Westpac, saying that their terminal rate was 4.6. So they
Oh
want
God.
another two raises,
Yeah.
you know.
Yeah.
Good luck with that. So this is Westpac's
Mm.
monthly inflation gauge as well, and so it picked up as well, 0.6 for the month of August, annualized. That's over 7. And I don't know if you've been to the petrol station lately, Tim.
Yeah. Yeah.
That's getting a bit grim, isn't it? Every week it's going
Well,
up.
everyone forgets food is basically petrochemicals. People don't understand it. Like, to make food, you need to use diesel to, plow the fields and make the fertilizer and, and
Mm.
to transport it to your supermarket. It doesn't just arrive there, it doesn't, just magically
But
arrive. Uses
we can
diesel.
get round that. We can get round that if we just all start eating bugs.
Yeah.
Just stand outside with your mouth open and you can catch a few.
Uh, but I just love it how, like, we remove the the volatile type things, but obviously it affects everything, How,
Yeah.
we're on a petrochemical standard here, so that's not going to change in the next couple of years. So I don't know what the US need to do something here. I don't know. Speaking to the Saudis, so I don't know if the Saudis are going to balk here and actually release more barrels. But if they do, well, this might get a bit of relief. But I'm sure
Yeah.
Biden's putting a huge amount of pressure on them. Like if they can't get this down by the election, boy, they're never going to win. So I'm sure there's going to be a ton of pressure put on the Saudis to release a heap of barrels. But yeah, we don't know. What do you think about oil? Do you think it's coming down, or you think it's going to stay high for
I
longer,
don't
or
know.
you
I
think?
mean, this is one of those things that, geopolitics comes into play.
Yeah.
I don't have any insights there.
Hmm.
I don't even pretend to. It's just, I have you ever, a few years ago started reading a lot of geopolitics commentary, signing up for newsletters and stuff. They're just, they're no better they're worse than economists, really.
Yeah.
I mean, I don't know. I don't trust any of them. No, who knows? We could be going back to the 70s. Who knows?
Mm.
Maybe the Saudis, it's not, Saudis might like a higher price. Just saying, they might
Maybe.
might like higher prices for the thing that they sell. Um,
Yeah.
yeah. So that's about all the macro stuff we have. Now I promised to have a look at this before we
Yeah, this is
did the
market
show,
access. I
and
forgot to put the
oh, it's all
spiel
right.
up here. Yeah.
But suffice to say that I have not looked at this at all. So
Yeah,
take it
yeah.
over, Tim.
Yeah, so this is Market Access. This is a company I've looked at a while ago and decided not to do a deeper dive because it's fintech and generally they have limited durability.
Yep.
It's currently down 65% since 2021, but it's
Mm-hmm.
up since 2017 by 100%, 1,000% by since 2004. The free cash flow yield is 4.5% now, so that's really good. And it looks like it's quality. So I thought, oh, might have a bit more of a dive back into it. It was
Mm-hmm.
founded in 2000, mainly providing electronic bond trading. It controls,
Right.
at the moment, about 50% of the market is still voice and email bond trading. Clearly,
Right.
there's tailwinds for this to change. And over the next decade, should become about 70 to 90% electronically traded due to cost efficiencies and more complex scenarios you can run. They
Yep.
current they currently control 80 to 85% of the electronic corporate bond trading in the US, which is only about 20% of the total US bond trading market.
Yep.
As they are market leader, they have higher liquidity and integrated into more service offerings, so they add high value to clients. They purchase small bolt-on companies, generally under 100 million. So far this has been accretive. Most impressive, they're focused on bond and credit, and they're adding value to clients. So they're currently adding a bit of munis and government bonds, but that's a smaller part of their pie at the moment. In the GFC, they did well, but they're only a small company. In COVID, they only decreased by 15%. So this is going back to that durability type thing. What do they do in bad markets? You want something that's hold up in all markets. Let's look at the fundamental. Shares outstanding are declining. Employees are in growth is in line with revenue. The price to earnings is about 30. Price to free cash flow is only 20, which is extremely cheap for something with this sort of quality. Return on invested capital and ROE are extremely high and stable. Margins are almost criminal. Got a small dividend, but a large payout ratio. No real debt, as the interest coverage is great. The growth rates are exceptional and in line with Microsoft and Visa.
Yep.
If we flip over to the balance and cash flow, we can sort of see no debt, heap of cash in the bank. Cash flow has more than doubled in 6 years and are on track for another great year.
Right.
Flip over to the multiples on the last one. They've never been lower.
Really, never been lower.
Um,
What any insight as to why that is? Why it's slightly on the nose?
Yeah, well, the market is hating it because bond issuance and trading are lumpy. So you get less fees, which is how they make their money. And they've just got a new CFO. And obviously, fintech is sort of conflated with banks. And you know what? No one likes banks, especially regional banks at the moment. Everyone hates them. So, and you've got TradeWeb, which is the more well-known brand. You see it on Bloomberg, and they do all the data for them. But they're really in a different area, and the other competitor is really too small. There's nothing you can buy in this market that I can see with this amount of quality for this kind of price. For me, I think there is a significant moat with significant tailwinds. And if the market continues to lump this with fintech and banks, this might be a steal if it can get down to a low, 20 PE. I just can't really poke holes on this one. So
when you said at the beginning that 50% of bond trades are still so a bond trader rings up somebody else and says, I've got US treasuries for this, and then they book the order, and then they just send it to the operator in the room, and he actually puts it through. So it's the old way of doing it, like when I was in 25 years ago.
Yeah, like you see on TV type crap. Yeah.
Yeah. Instead of just sort of putting a bid into a screen and then that bid getting taken out electronically. Wow.
And you can buy tranches, and you can do strategies. I if it falls below this level, you can buy this amount. I want to buy, if the market's weak, I want to be buying a bigger tranche. You can't do any of that over the phone or email. Or you can't buy multiple buyers. You can't access multiple liquidity pools. It's just horrendous. There's no way in the world the market is going to stay like that. There's no way. Just because of the cost efficiencies and the spreads you get are just insane. I know it employs a whole heap of people at Wall Street, but we're trying to fire all these guys.
Yeah, I never understood that. Especially after 2008 and 9, you would have thought a lot of that would have got cleared away, right?
Yeah, well, it did. It's just they're still bond guys are really old guys.
Still hanging on.
Yeah, they're really hardcore guys. They're not like the softy freaking equity dudes. Like these guys are hardcore. Like they'll fight you in the street type guys. These guys are like pretty wild. Yeah. So they don't exactly change too quickly, but the slow incremental change will happen. Just as new guys get put into the system, they get better execution, lower fees, they can, clients are definitely going to go for them. I'm sure, Bridgewater and all these other guys use this. There's no way that they wouldn't use this, so I'd love to speak to them. Anybody got their phone number? I'd love to have a bit of a chat and see what they think about the mode, but yeah.
Yeah. I noticed all those metrics are really good, the profitability ratios, but they are all declining. Like you look at 2016, like return on assets. Well, I don't really care about return on assets, but return on equity, return on invested capital, all on the decline. The gross margins on the decline. The operating margin, they're still good. I mean, they're still great, but it's slowly being eroded, and I just wonder why that is.
Yeah, obviously there is a little bit of competition, but
yeah,
I think this is going to be the other thing I can see from this. It's a takeout bid. So ICE, S&P Global, Moody's. There's a whole raft of companies who would like to take this over, I think, and just buy it out. Oh, that could be a lovely bolt-on to one of their companies. And that's just, that's an upside. You could get 30%, but I don't want that. Like I want to buy something that hold on for 5 to 10 years. And so I don't know, but so it's definitely quality. But you're right, those numbers aren't getting better. But with scale, you've got to expect that. You can't have growth rates of 14% a year and expect you're going to keep your margins. So
yeah,
because they're going into government bonds and munis now, which is TradeWeb's type area. So you're getting a little bit more competition
more
there.
competitive. Yeah.
So as you can see, the numbers are. But I just like it how they're sticking to their lane. They're not really going, oh, we're going to go muck around at equities. We're not going to go, well, this needs to be, done really well. Focus on here. Return all the capital, share buybacks, as you can see, or, a dividend or small bolt-ons. Yeah, so just how good is the moat? This is the thing it's just a bit harder to see,
Well, it does seem compared to a lot of the things that you've been throwing up, it just seems a lot cheaper.
Yes.
And it's not apparent just on the surface as to why, even though, because the metrics are great, aren't they?
Yeah.
Yeah.
But that's the sort of thing you look back and go, like everything was great, but I did nothing. Why didn't I?
Yep.
And like at a 20, you shouldn't be able to pick this up for a 20. Price to free cash flow 20. I know the PE is a little bit more expensive, but this really
but
should
again,
be
it's like you said, it's historically low. It hasn't.
Yeah.
Hasn't been this low in the last 6 years.
Yep. So I don't know. One of those things that, but I've put this for a 30% discount. So for me,
from where it is now.
Yeah.
So you want a price to free cash flow ratio of down around 12 or 14, 13, 14.
Yeah. So because I'm like, I just can't fathom moat. And I think the market is going to throw this out. I think financials, they're going to hate it. Like they just hate financials at the moment, like banks. They just can't do anything right. And I think this is getting lumped in there with it. Because when you look at it, look, they can't even spell their name right. Like it just like a terrible type, industry to be in. But once you understand what they're offering, you can see why like I wouldn't compete against these guys. You'd have to be freaking insane. Like to go, I'm going to create another electronic bond trading system. Yeah, you got something wrong with you. Just because they've already got the liquidity pools. And once, bond traders start using those liquidity pools, I think it's going to be very hard to, switch out of them because you're going to get better execution. So, this one I've put on my list.
There you have, people. Tim's brought another one. This one is, looks quite a bit more attractive in terms of price, doesn't it? Valuation. So there you have it, people. We will see you next week.